So why is math so important when it comes to making investment decisions? You might be sitting there saying, oh, I don't want to have to do math. I did that in elementary and high school, and I thought it was done. I thought it was over. But the reality is, if you really want to make an accurate determination of what your rate of return is on a particular investment, you're going to have to engage in a little bit of math. And to just sort of underscore that, we're going to work through a very specific example that we saw just this past week of someone who made a decision about $250,000 and did so based sort of more on emotion and not necessarily the basic math. Or I fear the reality is that they may have accepted the math that the annuity salesperson told them or showed them, but there was a little bit of sleight of hand on that math. So we're going to talk about where that comes into play and how you can actually, with some basic math skills, figure out what your true rate of return is. I'll tell you what, in this particular case, the rate of return, if you went from 7.25% all the way down to 0.6%. That's a big, significant gulf in terms of what those numbers are. And then, of course, you've heard it. We've heard it. We've talked about it on the radio program. The great wealth transfer, this notion that by some estimates, $73 trillion is expected to pass from one generation to the next one over the course of the next 20 years. We're going to go over some of the things that you need to be aware of if you are sort of on the giving side of that equation. So those are the topics on this week's episode of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also coming to you on a host of radio stations throughout the Central Florida region. Also a top 25 financial planning podcast. So make sure you subscribe to us on your favorite podcast platform of choice. Any trouble finding us, go to our website at Nelson Financial Planning, and there you can get instantly connected. Once you're there, make sure you hit that subscribe button so you don't have to do that again. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of folks that happen to also be certified financial fiduciaries. They stand ready to help you improve your life with a successful and cost-effective financial plan. So another week, another period of volatility. As we have said before, when volatility creeps into the markets, it has a tendency to sort of stick around. I guess this past week showed both parts of volatility. Remember, when we talk about volatility, there's up parts and there's down parts. There's up days and those down days. And that's certainly a pretty important reminder that many of those best days in the market are, in fact, clustered around those worst days as well. Because volatility, of course, has both sides of the equation. Plus, of course, you don't need the president and the Federal Reserve Chair fighting. I'm going to fire him, maybe I'm not. Those kinds of conversations certainly create a high level of uncertainty. And that, of course, is one thing that the markets don't like, is some level of uncertainty. That's how the week started. And then all of that sort of got walked back, along with some tariff walk back, all of those kinds of things. So to that end, it certainly was an interesting week with how much volatility, a few days where that volatility was certainly more to the upside than the downside. The reality is that the Federal Reserve conversation is, I think, an interesting one, and one that bears a little bit more of a conversation this morning, because I do suspect that the Fed is probably primed to cut rates. Clearly, they've gone through a period a couple of years ago of raising rates. Then they've shifted that to cutting rates. Now they're kind of in a sort of a wait-and-see kind of mode. And what's interesting is, I don't know if you saw this article in the Wall Street Journal this past week, but it was entitled, "Trump is Everywhere Except in the Economic data, which the article was talking about sort of the economic data, where it is today versus where it was 6 months ago. And just to give you perspective on what that was in that article, so far, for example, job growth has averaged about 173,000 new jobs created over the course of the past 2 months on average per month. That's almost the same as what it was in the prior 6 months. Unemployment at 4.2%, pretty standard as well. That's a mere 0.1% higher than where it was 6 months ago. And inflation, in fact, actually running 1/10 of a point less. So the article was sort of explaining, if you will, why the Federal Reserve for now seems to be kind of adopting this wait and see mode. Because you're really, even though Trump is sort of dominating the headlines, I mean, you'd be hard pressed to forget that he's president right now. The reality is that he's not necessarily, or it's not necessarily showing up in the economic data. So if I'm the Fed Reserve and I'm looking at this and I'm saying, well, okay, there's not really anything in the economic data that's going to cause me to move based on where I am or where we have been as an institution over the course of the past few months, then, maybe we just keep kind of seeing how all of this plays out. I guess that sort of underscores another of our sort of long-held beliefs on this program, is that certainly while presidents can shift things around, really most of that shifting happens at the margins of the economy, because the economy is just so massive, so complex, that its underpinnings certainly can't be changed pretty easily. Now, the reality is this tariff conversation, although the more the tariffs get paused or unwound or those kinds of things, then perhaps it doesn't have as much economic impact. But clearly, the conversation about tariffs is to the extent that it has have an impact. Obviously, that would be a bit of a lagging impact in the economic data. So come these next couple of Fed meetings, obviously pretty important. I think the Fed might be inclined to move eventually, particularly if some of this current headline starts to show in the economic data. But I doubt they're in line to cut rates at their next meeting, because that's coming up really soon. May 6th and 7th is the next time they meet. Probably more likely the June meeting. That's in mid-June, June 17th and 18th. Again, assuming that there's some impact that shows up in the economic data. Time, of course, will tell on that. Stay tuned, as we like to stay here in the radio biz. The other thing that came across my desk that I thought was kind of interesting is this notion of how do you put yourself on the best possible shape for your future, your retirement, right? How do you put yourself in the best possible shape? And recognizing, of course, that if you are a couple, age 65 today, chances are there's a pretty good chance that one of you is going to live 25, maybe 30 years. Just for references, that's like another 6 presidential elections. So if you don't like the current one, then just kind of wait a minute and there'll be another one. Anyway, what's the secret to success through all of this? Well, according to a recent T. Rowe Price study, the answer may surprise you as to what the key commonality of financial success in retirement really was, and ultimately, I guess, give you some direction as to how to improve your overall financial picture. So you might be listening to the program and saying, oh, it has to be that those that retired well, maybe they saved more, they had better paying jobs, they were doctors, lawyers, Indian chiefs, things like that, or they did some savvy investing. But new research suggests, according to the folks at T. Rowe Price, that the single biggest differentiator to a successful retirement is having an actual plan itself. It wasn't about socking away more money or doing it in a different fashion or whatever the case may be, but doing it in a manner that was purposeful and planned out. The T. Rowe Price survey found that individuals with a formal financial plan were found to have 2 to almost 4 times more wealth when entering retirement than those without. Stop and think about that. Simply having a game plan puts you much better off than if you didn't. Doesn't that kind of make sense, right? With that, we're going to take a break and continue after these messages here on Dollars and Cents with Joel Garris of Nelson Financial Planning. this segment, we wanted to talk a little bit about how important math is to making a quality financial decision when it comes to your money. So think back. We're going to go not like high school math, like geometry, trigonometry stuff, which I don't how often do you use that in regular life, right? No, we're going to go back to like probably elementary school and talk about that kind of math. So don't get too intimidated about what we're going to talk about on this segment of the program, because it is very simple math, but it's important to follow the steps, right? You got to follow the steps when you're trying to use math to calculate things, because otherwise you could very easily get hoodwinked on what your return, and we use that term loosely because many in the industry unfortunately do, what your return is on the investment choices that you make. In this segment, we're going to go over a specific example that we saw just this past week and really use that to sort of underscore why it's so important to kind of understand how the math works. So again, math may not be your strong suit. Perhaps it comes easier for me. I guess that's a good thing because I'm kind of in this industry, so kind of deal with numbers and math. So, you would want it to come maybe a little bit easier for me. But the reality is, though, that we're talking about some basic understanding. We're not talking about calculus. We're not talking about trig. We're just division, addition, subtraction, multiplication, division. That's all we're going to be talking about in terms of how to best figure that out. So here's the story. Someone came into the office for the very first time this past week. It's explaining to us that they had decided to take $250,000, so not an insignificant amount of money, and at age 70, they had proceeded to put it into this particular product that was going to guarantee them a guaranteed monthly income for at least a 15-year certain period of time. I mean, obviously that might have some appeal, I guess, in today's world, particularly if you're, spending way too much time in media or social media or television or whatever the case may be, and just losing all perspective of kind of what's going on out there in the world at large. But so it's easy to look at a product like that and say, oh, that's hey, that's a guarantee. I don't have to worry about anything. So why wouldn't I do something like that? The problem is that when you run the numbers on it, you very quickly see that it's a guarantee of nothing. It's an illusory guarantee, if you will. So here are the specific numbers. The product that this individual invested in was something called a single premium immediate annuity, or what some people refer to in the abbreviated terms as a SPIA. Okay, so this individual invested, like I said, about $250,000. It was actually $246,000, and in exchange for that, she was guaranteed monthly income of $1,487 per month for the rest of her life, with a 15-year term certain. Now, a couple of details to know on this particular conversation. First is that the monthly income is never going to change. Okay, so the way that's set up is it makes the calculation and it generates out that monthly amount for the rest of your life with no changes, no inflationary adjustments. I'm sure there's some products out there that might allude to that or have that, but this particular one did not. So that's kind of important, right, in today's world, because if the income is not adjusting to impact for inflation, what's happening? Inflation is eating away at the value of that monthly payment. Just look at the past 4 years, where the cumulative impact of inflation has been like 20%. So that $1,487, because of the impact of inflation just in the past 4 years, only equates to about $1,190. So the second point of this is that, so first point, okay, no inflation adjustment, that's a major problem. The second point is that the 15-year term certain relates to the number of years that the income is guaranteed to come in. So if this individual passes at year 10, okay, then it's going to continue for another 5 to her beneficiary. If she passes in year 16, then it stops. There's nothing more besides that. So that's the notion of that 15-year term certain. So on to the math, if you will. And it's basically an exercise in calculating your rate of returns. And the reality is that you don't simply want to include the return of your original investment when you're calculating your rate of return. And unfortunately, that's what a lot of salespeople do is, and that's not what return is. It is return of something. It's return of your principal, but that's not any part of an actual rate of return on your investments. That's not profit. That's not growth of money. So how do you do that? What's the first thing that you need to do? Well, first, in order to calculate a rate of return, generally you think of those on annual basis. So you got to take the 1487 amount and multiply that by 12, right? So that's multiplication, easy enough. So 12 times 1487 is 17,844. Now, right here's where the sleight of hand comes in. So the annuity salespeople then calculate the rate of return and say, okay, well, if you're getting 17,844, well, then just divide that by the amount of money that you are investing, in this case, $246,000, and voila, that is a return of 7.25%, right? So you take the 17,844 number, divide it by the 246,000, multiply that by 100 because you got to do that in order to convert the number over to a percent rate of return, and you get 7.25%. That's great, except that's actually not even close to being accurate because you get your money back. That's not a rate of return. So you have to watch the math because the presentation says it's 7.25%, but that's not the right calculation. The right calculation goes something like this. Stay with me here, folks. But really, this is all just multiplication, subtraction, and division. So here we go. 15 years is the amount of time, right, that the monthly check is going to get dispersed here. So take the annual amount, right? We did that 12 months times 1487. That's the 17,844 number. That's what you're getting in a year. So 15 years, which is the term certain, that's 15 years times that 17,844. That's $267,660. Okay. Now, here's what you got to do next. You got to compare it to what you invested, which in this case was $246,000. That's your profit, folks. That's how much you made by doing this investment. That's $22,000 over a 15-year period of time. Figure out your actual return. Divide that number then by 15 because it's annual, trying to figure out an annual amount, and then compare that to the original investment. $22,000 divided by 15 is $1,467 per year of actual rate of return. Divide that by the investment of $246,000, and congratulations, your rate of return on the product is 0.6% per year. That's right, not even close to the 7.25. A 7.25% quoted return actually becomes a real return of 0.6%. That should shock you. But we see it all the time. The math and the sleight of hand that happens with the math, you have to be really, really careful. When we get back, we're going to spend a little bit more time on this, and we're going to detail out the 3 steps, the 3 parts of this math thing that you must do in order to figure out what your proper rate of return is for any investment that you make. Coming up here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Welcome back to Dollars and Cents, where we, I guess in the last segment of the program, help you with basic math as it relates to how you calculate out your investment return over time. That's important because when it comes down to it, you want to make sure that you're actually getting the return that you think you're getting. In the last example, which we're going to recap a little bit more in this segment, we showed how a 7.25% return, and we're using hand quotes on YouTube, becomes an actual real rate of return of only 0.6%. Those are the kinds of things that unfortunately we see all too often at the office at Nelson Financial Planning, which is why we always encourage folks to come in for a second opinion at any point in time with any of our certified financial fiduciaries, because they do that at no cost. All of our conversations at the office are no charge. My name, of course, is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries can certainly help you make great decisions with your investments. So let's recap all of this, okay? So not to turn this into, and this is kind of elementary math, so it's not really, I mean, we're not talking trig here or calculus or geometry, things that I don't know that most people use a whole lot in their everyday life. But they do use addition and subtraction and multiplication, division, which pretty much, if I recall correctly, it's been a while, that's what you did in elementary school. So how do we calculate that return? There are 3 distinct steps, and here's the thing. A lot of the annuity sales stuff will skip the second step. Don't skip the second step because it's going to change everything dramatically. Step 1. How much am I going to get over the time period of the product? That's multiplication. Okay, so I'm going to get X number of dollars per month. Okay, times 12. Well, that's how much I'm going to get. That's why. That's how much I'm going to get. Like, I should stop using X and Y because that starts to sound a lot like algebra, doesn't it? So scratch that. Take the money you're going to get on a monthly basis, multiply it by 12. You have a number. Then take that number and multiply it by the years of which you are going to get that particular payment. So in this particular case, that we were describing earlier was 15. So there's the math. That's multiplication. Now you have, here's how much I'm going to receive in my pocket. Okay, here's the crucial second step that you've got to remember to do. That total amount that you just calculated. Subtract, pretty simple, subtract out the amount of money that you put in. It's a subtraction. Right? So in the particular case we were describing, over the course of the 15 years of that term of the immediate annuity payout, they were in fact going to get cumulatively $267,660. But then from there, you subtract out the original investment, which was $246,000, and over a 15-year period of time, their actual profit, how much more they were going to get in excess of what they put in, $22,000. That's just straight up subtraction. That's the step you cannot skip, because if you do, and you compare it back to, you compare the annual income back to the original investment, you're going to get a much, much higher number every time, because it's counting in the return of your principal to you, and the return of your principal is not part of your rate of return. All right, so once you've done the multiplying, okay, how much money am I going to get over the time period of the product? And then you haven't forgotten step 2, which is, okay, now I got subtraction. I'm going to subtract out how much I originally put in. Now I have my profit, and it's profit then that you use to calculate your rate of return. Compare that amount back to the annual of what that would be. So in this case, it was $22,000 of profit divided by 15 years, because that was the term of the product. So your annual profit, $1,467. Now do some division. That's when you compare that back to the original amount of the money that you invested. You do have to, once you do that calculation, actually I do have to do some multiplication at the end times 100. So that's easy. Just slide the decimal place over a couple points. And then now you've got the rate of return. So there you go. That's how you calculate your rate of return. So it's multiply, step 1, step 2, subtract. That's the one that everybody misses. And then step 3, divide. Don't skip that second step, because if you do, your rate of return is going to go from 7.25%. And the reality is that it's actually 0.6%. So if you're making an investment decision, right, you kind of want to know what your actual real rate of return is. You have to do the math. I mean, stop and think about how big that spread is, right? 7.25% versus an actual 0.6% return. One is the real number. Unfortunately, the lower number is. And the other one is just, frankly, just plain nonsense that doesn't even really have anything to do with your rate of return. Again, you cannot count the return of your amount, your principal invested, as part of your rate of return. It doesn't work that way. It ignores basic calculation of how investments work. But I'm telling you, you'd be surprised. We see this all the time. Make sure, as we've said for years and years and years on this program, run the numbers, do the math. You have to do this analysis, and I understand that it might be a little out of the ordinary, but I assure you it is elementary school mathematics that we're talking about here. Know how to do it, and at the end of the day, you're going to be able to figure out what your ultimate rate of return is on your investments. So, enough of the math. Let's continue the conversation in terms of some of the things that are going to be happening over the course of the next 20 years. I'm sure you've heard this headline, the Great Wealth Transfer, as it has been described, expected to have a transfer of over $73 trillion from one generation to the next over the course of the next 20 years. Obviously, that's a massive wealth transfer that has some profound implications throughout the generations. And so we want to talk a little bit about it and give you 4 tips to really sort of follow to help ensure that any transition that you are doing happens smoothly. So the first sort of line item of things that you need to do in order to make sure that these transfers happen effectively is to make sure you have your paperwork in order, right? This is all just paperwork stuff, but you got to make sure that you have your paperwork in order. This includes having the necessary legal documents such as a will or a power of attorney or even a trust. Now, a will, that's actually the document that goes through probate and lays out exactly who gets what, but ultimately that process of determining who gets what is the process called probate when you have a will. If you don't have a will, it's called intestate. That's a whole nother ballgame because then the state statutes will apply as to who gets what. So that's a will. Power of attorney gives somebody the ability to act and operate on your behalf. Maybe that can be financially related. Maybe that can be health related. If you want to have a greater level of control over your money once you pass, well, that's called a trust, because then a trust would have different parameters in there that deal with the disbursement of money over the course of time. So that's the paperwork smorgasbord, if you will. Beyond that, you want to check your beneficiaries on your various accounts. So if there's not beneficiaries named, then it's going to go through probate and go through your will. If there aren't beneficiaries named, you can avoid all of that by simply doing the paperwork to be able to do that. The things like putting a payable on death on an account, putting a transfer on death on an account. For a piece of real estate, you could even use what we affectionately refer to as the ladybird deed, which basically is naming a named beneficiary on a piece of real estate. All of those are options. All of those are part of that first tip to getting your house in order for any potential wealth transfer down the line of getting your paperwork in order first and foremost. We got 3 other tips on this topic, but we're going to take a break. Coming up next here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So we're talking about some tips that hopefully you can use in order to make sure that any wealth transfer from one generation to the next goes as smoothly as it possibly can. This all has to do with what is described as this great wealth transfer that's expected to occur over the course of the next 20 years, where $73 trillion of wealth is expected to pass from one generation to the next younger generation. And so before the break, we were talking about sort of that first thing that you can do, and that, of course, is making sure that you have your paperwork in order, right? If you have your paperwork in order, then things have a tendency to go a little bit more smoothly. So make sure you take take the time to have that will, that power of attorney, or even that trust all in order, along with checking the beneficiaries on all of your various accounts. If there's not a named beneficiary, then go ahead and name one. Make sure it's as part of that account registration, either through a payable on death, a transfer on death, or in the notion of a piece of real estate here in Florida, you can use a ladybird deed, which effectively is just a transfer on death type of registration for a property. So that is sort of tip one. The second one is don't just set it and forget it. At the end of the day, all of this needs to be reviewed about every 5 years, plus or minus. A lot of that simply reflects the life changes, right? Life changes for all of us in terms of how things ultimately play out. And certainly the folks in Washington change the rules on a regular basis as well. Another reason why you want to not just set this and forget it, but rather take a look at it on a regular basis to see if there's any adjustments that need to be made. The biggest one, particularly as it relates to wealth transfer from one generation to the next, of course, is the estate tax exemption. Now, today, nobody's really paying attention to it because it's at $14 million per person. But as things stand right now, in a matter of 8 months or so, January 1, 2026, that $14 million number is going to drop about in half, down to $7.25 million. Now, widely expected the folks in Washington are going to do something about that. They're not going to just let that sort of drop and shift, but you don't know. I mean, who knows when things get actually accomplished in Washington. As it stands right now, that $14 million is going to drop down to $7.25 million. So pretty significant shift in terms of what that estate tax exemption is going to be. Further underlying the necessity to make sure that you're reviewing this stuff on a regular basis. Third, in terms of the tips to assist with this wealth transfer, don't forget to phone a friend, right? Hopefully that friend is a professional because you're going to want some professional assistance with this. Yes, there are certainly plenty of online resources out there for pretty much everything these days, from investments to estate planning, but the more you have, or the more you have family dynamics, and who doesn't have that, the more you need some expert advice, whether that's legal or financial. I often describe it this way. You know, I have a set of steak knives at home. They're nice steak knives, but it doesn't make me Bobby Flay. Although of late I've been kind of intrigued by Andrew Zimmerman. I don't know if you've watched his program, The Open Fire Cooking. That's just kind of neat stuff. Got a great eggplant recipe off of that. Anyway, I digress. The reality is there is a level of nuance and expertise that comes into play when you are looking for a much more finely tuned approach. And then lastly, in terms of the sort of the 4 tips we're giving today on how to best handle this wealth transfer from one generation to the next, don't surprise everyone, right? Because if you're not having the conversations with your beneficiaries, you can't really have it after you're dead. So you probably want to take the time and engage in some of these conversations along the way. Always better to err on the side of communication. Now, all this, these topics are certainly covered in more detail in our book, Next Gen Dollars and Cents. In fact, this today is the last day that it is featured at the Los Angeles Times Festival of Books out there in Los Angeles, being held at the University of Southern California this weekend. And so today marks the last day. And so certainly a great honor for our book to have been selected courtesy of an editorial process. I think, as I have said before, it's probably more the topic that is timely rather than my great writing style. Anyway, a couple of chapters in the book deal directly with this particular topic. Chapter 19 talks about death, some of the things to be aware of on that from a financial perspective. And then chapter 20 details some of the pitfalls of inheriting money. So sort of both perspectives out there in the book. Remember, to get your absolutely free copy of your book, so you don't have to pay the folks at Amazon or Barnes & Noble, then you can simply take us up on our offer for an absolutely free conversation at our office at any time. Nelson Financial Planning is located in beautiful Winter Park, Florida, very close to the Lee Road exit of I-4, easy to get to our office at any point in time. And ultimately, we're here to help you. And in order to do that, we do that and make sure that all of our conversations are done free of any cost whatsoever. So, bottom line, remember those 4 key points when it comes to effectively transferring wealth, particularly as we stand on sort of this threshold of the largest wealth transfer over the course of the next 20 years. Number 1, make sure you have your paperwork in order. Number 2, don't just set it and forget it. It needs to be relooked at based upon changes, not just for in your personal situation, but also out of Washington. Number 3, make sure you're bringing in some outside help. A little professional expertise goes a long ways. And then number 4, don't leave your beneficiaries with a surprise after you're gone. Make sure you're taking the time to really communicate and ultimately go over what your plan of action is going to be. You know, a lot of these tips on estate planning apply to singles as well, because that is such a growing population of retirees. Solo retirees are now becoming much more prevalent than they have been in the past. People age 65 and older who live alone make up over 10%, 11% of all households as of 2020. That's up about 20% from where it was just over the prior decade. About half of women and 29% of men age 65 and older are not partnered. The reality is that those figures are expected to rise as more younger adults reach retirement without a partner. For that population that is aged 25 to 54, about 38% of that population was unpartnered as of 2019. That's up from 29% in 1990. So a pretty significant increase in sort of the number of singles out there or unpartnered individuals. You see that in the marriage rate. 53% of that age group, 25 to 54, was married. As of 2020, that is down from 67% in 1990. What does all that mean? Well, the same rules that we just applied in terms of estate planning, they apply even more so, and I think with 2 notable exceptions that we've also wanted to point out. First of all, your support team has to include more than just professionals. Good to have professionals in terms of creating the legal documents, the tax documents, all of those kinds of things. But your support team also has to be social in nature, group of friends and folks that provide companionship and help each other from time to time, crucially important. And then the other sort of exception for that sort of single population is your professional team of people that you're using has to be much more fully vetted. And by that, I mean, this comes down to when you use them or name your accountant or your lawyer or your finance person, your decision maker for maybe health or financial well-being. You've got to make sure that you're fully vetting that, because that does create a different set of circumstances to the extent you're using a non-family member for those types of decisions. So some important things to certainly remember when we think about estate transfers from one generation to the next. So hopefully you found the program interesting as always. We will be back next week, as we are each and every week here on Dollars and Cents. I think we'll have one of our fellow certified financial fiduciaries join us. I believe Christina Lamb is next on tap. So be sure to listen to our program next week when Christina will be joining us here on Dollars and Cents. If you have any questions about anything that we talked about on the program, feel free to reach out to us directly, courtesy of our website, nelsonfinancialplanning.com. That's open 24 hours a day. You can always send us a message or request a free consultation at any time. My name is Joel Garris of Nelson Financial Planning, and this has been Dollars and Cents.